See me well. Thanks for joining us today. This has become a very popular topic. I think building wealth, investing, etc. But we wanted to present a slightly different take on it. Everybody's telling you what to do all the time. We want to talk about what not to do, because in the process of building wealth, that's as important as you will see. So let me share my screen. Right.
I'd request people to just turn on their cameras to have more interaction and see more people. So that was the part I missed. So requesting everybody to the screen. Yeah, please continue.
Great. So let's get started. Right. As Aisha said, I think we're talking about wealth here, and the question for all of you is: are you making any of these 10 big money mistakes? Of course, there are a lot more than 10 money mistakes. We'll focus on the 10 that we think are the most interesting and that are the most relevant to the wealth or investment context, right? So let's get started. Now, some of you may be wondering why talk about mistakes, right? Here's a picture of somebody famous. How many of you know who he is? If you know who he is, please feel free to type it in the chat box, chat window, sorry. If not, I'll keep going. This is the partner of Warren Buffett. He's been working with Warren Buffett for over 60 years. His name is Charlie Munger, widely known as a wise man, almost 100 years old. And he made this very interesting statement that, you know, it's remarkable how much advantage they got by trying to be consistently not stupid rather than trying to be very intelligent. So basically, the idea is that rather than always trying to do heroic things or win, sometimes just by avoiding mistakes or avoiding doing stupid things, you can win. And that's what we want to focus on. Sometimes that's the easiest way to get started. So let's move on, right? I'll give you a quick summary of what 10 things we want to talk about today. And then we'll run through each of them in more detail. We'll leave a little bit of time at the end to talk about Mighty, who we are. And then finally, of course, like Aisha said, we'll have Q&A. And hoping to take a lot of questions from you. So what are the 10 things, right? First, not taking enough risk. You must be hearing from parents and such people, don't take too much risk. This is the opposite. Not taking enough risk is also a problem, is a mistake. Second, buying a home too early in life. Third, seeking excitement and fun from investing. Fourth, waiting for perfect knowledge before investing. Fifth, trying to time the market. Sixth, placing too much trust in the recommendations of friends or influencers. Seventh, chasing the hottest thing after it's widely known. Eighth, buying the dip in individual stocks. Ninth, buying unregulated financial products. And 10th, foregoing easy tax savings. Right. So let's get into it. I'll start with the first one, not taking enough risk. So let's jump right in. Right. How does household wealth in India look? If you look at the money held by all Indians across the country, what does it look like? Where is it owned today? Right? This data is 2 years old, but still the conclusions would be the same. Only 8% is in listed equity and mutual funds. Around 40% is in gold, real estate, jewelry. Around 50% is in FDs, savings bank accounts, bonds, insurance, PPF, etc. So you see 50% is invested in products that typically generate 7 to 9% returns. 40% is in products that generate anywhere from 6 to 11% depending on your luck. And the products that can generate, let's say 11 to 14% returns have only 8% in them. So that gives you a sense that most people in our country are not taking enough risk to grow their wealth. One of the fundamental principles of finance is that returns are correlated to risk. And if you want to grow your money fast, if you want to earn good returns, you need to be willing to take more risk. Right? Of course, it needs to be done thoughtfully. Right? The point is, if you're not taking enough risk, you may be missing out. So let's talk about a little bit more with examples and numbers. Right? So first of all, playing too safe can have a big opportunity cost. What is opportunity cost? You have the opportunity of getting something which you don't get. That's opportunity cost. Sorry, somebody said there's an issue with the mic. I hope it's working smoothly. I'll keep going. look at this chart. This is a chart of someone's net worth over time. I'm showing the net worth of two people over time. And the key thing here is these are, let's imagine that they're two friends who started working at the age of 25 and are working till the age of 60. Right? They have the same income, the same savings, everything. But their net worth looks different. Why is that? One of them invests her money at 12%. The other invests her money at 6%. Right? As you can see, the absolute amount of money here is not important because it depends on what is their level of savings, earnings, etc. But the difference between these two people who are earning and saving the same is almost twice by the time they retire, just because one of them took no risk, put all the money in FDs, the other took a little bit of risk and earned a better return. This gives you an importance of why should you care about taking risk? Why should you care about taking returns? Because over a long period of time, it makes a huge difference to your financial well-being. Now let's look at actual data in the last 20 years in India. Right? If you had invested your money 20 years back, 1 lakh rupees in a bank FD, it would be worth about 3.83 lakhs today. Okay, roughly 7% rate of return. If you had instead invested that money in the Nifty 50 index fund, which is roughly a proxy for the stock market, it would be worth 23.8 lakhs, roughly growing at about 17% returns. Now, of course, every 20-year period may not give you 17% returns, but the point is people who took more risk came out ahead. Of course, it was not a straight, smooth ride. There were some ups and downs along the way. Maybe it was not easy to stay on the path, but in the long term, these taking risk actually works out okay. Right? So that's the kind of main takeaway here. And the other thing I want to emphasize again is that when it comes to building wealth long term, time is a primary factor. It's not about finding the hottest investment, finding the best stock, getting lucky, all of that stuff. It's about being patient, consistent, and compounding your wealth over time. Right? And I want to use somebody who is probably the best example of this, who's had a 65-year career in actually investing. Any guesses who that could be? Okay, now I'm sure all of you know who this is. One of the most famous people in the world. At various times, he's been the richest or the second richest or the third richest person. And if you look at how his wealth has progressed over time, today he is estimated to be worth $80–90 billion. He's about 90 years old. But if you look at how his wealth progressed over time, this is what it looks like. Right? Today, he's got north of $80 billion. But at the age of 50, he had less than $1 billion. He had 0.4 billion. He had $400 million. He started investing around the age in his early 20s. 30 years later, he had amassed about 400 million. Another 10 years later, he was at 4 billion. And then he kept going. He kept investing. 30 years after that, he's at 80 billion. Right? Now, the point here is sticking consistently with investing and compounding your money over a long period of time is what builds wealth. It's not doing something exciting and fast, getting lucky and all that stuff. So that's one thing I would want you to take away from this session. Right? So let's move on to the next part. Slightly subjective topic. A lot of us here, like we saw earlier, real estate is a very common thing people like to own in our country. And so another common thing is, a lot of us get advised to buy a home very early in life. And according to us, it's a mistake. So let's talk about why. Let's start with an example. Right? Let's take somebody who buys a home worth about 1 crore right, today. 20 years from now, assuming it grows at 6.5–7%, this is the same data that RBI has produced. This would be worth about 3.6 crores. This person's home, right? Not bad, not bad. It's a good asset, but 6.7 not that exciting. There are a few things we haven't considered here. This person may be earning rental income, or if they're staying in the home, they won't be paying rent. Same thing. They get a lot of tax benefits because they own the home, and they can finance the cost of this home with debt, which means there are some additional benefits. What are the additional costs here? When they buy the home, they probably pay a 5% stamp duty. They have to pay maintenance costs. They have to pay property tax. Now, taking all this into account, a home may give you 10% in long-term returns over a 20-year period. Not bad. Okay. the question here is not really, should you buy a home? Right? I think we believe, and rightly so, yes, please buy a home. It's convenient. At a certain point in life, it makes sense to have a home of your own. Point is, when should you buy a home? Right? And so let's talk a bit more about that. A lot of you, especially if you're young, would be getting advice to start investing in. Right? And what are the common reasons why young people buy a home? And we'll also give you our opinion on each of those. Right? First one is, paying rent to the landlord is a waste of money. But when you pay EMI for a home loan, you're building an asset. What do you think? Does this make sense? Is this correct? Actually, the answer is no, because rent is a financial cost, financial expense, just like EMI. You're paying rent to your landlord, you're paying EMI to your bank, you're paying for the time for which you're occupying the home. There is no particular reason that's the waste. You paid for the time you spent in the home. So technically speaking, this is actually not correct from a financial perspective. Some people are raising some interesting points. We'll talk more. Like we said earlier, yes, factoring all that in, you get a 10% return typically. So yes. The second point that a lot of times we hear is real estate is the best investment. Why? Because you would have always some relative who got super lucky, bought a home, went up hugely in price, right? But nobody will tell you about the person who struggling to kind of sell their home, or whose price has not appreciated in value, right? Or somebody will tell you that my house has gone up 10 times in value, but they'll forget to tell you that it took 30 years to do that. So typically, and there's enough data on this is factually not correct. Though for a lot of people, it's the only asset class they understand. So you may say it is the best investment. Again, we disagree. This is not really the best investment if you have access to everything. Next, the other kind of thinking often is, without the pressure of a monthly EMI, I find it hard to save. Right? I'm somebody who doesn't have a lot of discipline. If I don't have somebody, a bank taking money from my account every month, I will struggle to save. Now this, unfortunately, this actually does make sense. And if this is the reason you're buying a home and you're not going to invest the money elsewhere, then yes, maybe please buy a home, maybe better off for you. Right? Finally, sometimes if you happen to tell somebody that I have some extra savings lying around my bank account and I don't know what to do with it, especially if it's somebody older, you may be told, hey, why don't you make a down payment and buy a home? Right? Again, not a great reason to buy a home. You're taking a long-term asset with a lot of work, a lot of maintenance. So consider that carefully before you get into it. Now, according to us, we're not going to get into numbers and examples here because it's a bit subjective and this can be an hour-long discussion. Rather, let us tell you very quickly what are the qualitative reasons we don't recommend or we recommend postponing buying a home. First of all, your salary in your early 20s and 30s may grow much faster than the price of your ideal home. Because of this, if you wait a bit, you may avoid this whole thing of, hey, I bought a home, then it was too small for me later, so I sold it. And you keep doing that, you keep paying stamp duty, incurring a lot of effort, not required probably. Right? Second, intangible factor, but somehow owning a home in one city restricts you from exploring better career opportunities in other cities. Right? You may have bought a home in Bangalore. Somebody makes you a great offer in Bombay. You'll think, hey, what'll happen to my home? Maybe I should just stay here. Why don't I just find a role here, right? When you're young, you should be flexible and just seek out the best things to do, but not necessarily optimizing your career if you go by this logic. Finally, like we said earlier, and we talked throughout this session, there are many other investment options which have provided consistently better returns than owning a home with much lower effort. A home takes effort. You have to think about maintenance, tenants, taxes, EMIs, various things. So great. Summing this up, let's move on. The third big money mistake, according to us, is when people seek excitement and fun from investing. We live in a world where right, easy access to investments. You've got apps, free apps, real-time tracking. You've got zero transaction cost to trade or invest. You've got this information widely, freely available where you can invest, you can research, you can do whatever you want. And news channels and social media influencers talking about investments and money all the time. So all this means you're surrounded by this topic. Right? to the point where it starts seeming like fun. It's something exciting. What happens when you start investing? When your investments are growing, it's fun. You feel joy, you feel happy, right? Some of you may know there's something called dopamine. It's a kind of hormone. When we experience something pleasurable, it's released in our body and we like it. It's a good feeling and we want to do more of it. So almost 50%. And when your investments are moving higher, your dopamine levels will rise. You like the feeling and you will want to make even more exciting investments, want your money to grow even faster. It's almost addictive. It's almost addictive. Now, but too much of this can be a problem. Why? Not because, hey, there's a risk of your money going down, etc. Right? That's kind of obvious. But why is it bad for you? It's free, it's easily accessible. Your consumption of it goes up a lot. You may start to trade excessively. You start monitoring your investments minute by minute. And this is harmful for your mental health. This is harmful. This is a huge distraction. It's harmful for your career probably. And worst part, it does not improve your results. Just seeing the value of your portfolio daily 3 times does not mean it goes up any faster, right? But it's a distraction. So it becomes a bad thing in your life. And for a lot of people, it becomes a game, it becomes fun. So for us at my team, when we talk to our clients, we always tell them that, look, investing is not fun. Right? It's not a game. It's very serious. It's about the financial well-being of you and your family. Please do the appropriate research, think through this carefully, take this very seriously and think long-term. Interesting data point that SEBI recently released of all the traders who are active in futures and options, 45 lakh people, by the way, 90% of them are making losses. Just think about that for a second. Actively trading typically does not make money, and now there is proof. Great. Let's move on to the 4th point. What is the most common mistake? Number 4, waiting for perfect understanding or perfect clarity before investing, right? There are imperfections all around us everywhere. Investing is a complex topic. It is not easy to understand, grasp, and because of this, you may procrastinate. What are the reasons you may procrastinate your investing decisions? Let's talk about those. You don't understand how compounding works, and we'll show you a bit of that. We already showed you a bit of that, and we'll show you a bit more. Second, investing is a complex topic. You feel ill-equipped to invest until you learn enough about it. We'll try and help you a little bit today and give you some ideas on how you can overcome that. Next, there are always good reasons to postpone investing. There's always a recession, market correction, interest rate hike, war, whatever it is, right? So if you really want to think that way, you can always come up with reasons. No, let's not do it now. Let's wait. Right? And finally, problem is that the benefit of investing is seen over 25, 30 years. But if you spend the money on something now, maybe you buy a new MacBook or you buy a new pair of sneakers, you get the benefit today. Right? So it's always easy to postpone investing and enjoy your money today. Right? So the point we are trying to make is delays in investing can cost you a lot. And let's show you with some examples, right? So our favorite concept always is to talk about 2 friends who are exactly equal in every way, except in their investment behavior, and then show you what happens because of the way they handle their money. Right? So both of these friends work in the same company, earn the same income, have the same savings pretty much, or at least they have the potential to have the same savings. Both are 25 years old. One starts investing today, right? The other doesn't. The other says, look, I'm young. Why do I need to save, invest? Let me worry about it later. Let me spend my money and enjoy. The first person starts investing 1 lakh rupees annually. The second person, 10 years from now, his income savings grow at 8% annually. So he's able to invest 2,16,000 10 years from now annually. Right? So he's investing more when he starts investing. First person invests for 35 years, second person invests for 25 years. Both earn 11% return. What do you think their investment value is at the age of 60? Who does better? Well, the way we've set up this question is kind of obvious. But what will strike you is the amount by which they're different. This is what it looks like. The first person will end up accumulating almost 8 crores by the time they're 60. And the second person will have about 4.8 crores. So the first person is almost 60% richer than the second person. right? It's just time at play here. It's not like he made better investments, etc. He was just disciplined. He started early, stuck to it. So a 10-year delay in investing can be quite expensive in opportunity cost terms. So please keep that in mind when you think I'll invest next year and I'll worry about savings and investing when I'm 40 years old, right? Right now I'm making enough money to spend and have fun. So please keep this in mind. What do you need to know about investing to get started? Some of you may be thinking, hey, I don't understand this topic. Do I know enough to actually start investing, right? And so we've listed out 4 or 5 things which I think are easy to understand, and you should know this and use this to get started. First of all, we've got a regulator called SEBI. It's a government body. They've done a great job, and most of your investments are extremely safe. So when you invest in stocks, mutual funds, bonds, these kind of products, you don't need to worry about getting cheated, your money disappears, something funny happens. No, of course, they're subject to market risk. They'll fluctuate, but you don't have the risk of getting cheated or something like that. So you can invest without fear. Second, over a long period of time, the stock market broadly grows the way in which the economy grows. So if our economy grows at a 6% real rate of return and real rate of growth, and inflation is 6 to 8%, you can expect 12 to 14% returns if you invest in the stock market. And you should have these expectations. You should not expect to make 50% just because you saw an ad or somebody is trying to sell you something. So be careful of that as well. Then it is not possible to time the market perfectly. Right? This is one of the mistakes we'll talk about later. You're more likely to be wrong that way. You're always better off just following a system, just following a set of rules, just following that blindly without worrying about where the market is. And finally, tax rate is important. Again, we'll talk about this more in detail, so I'll skip this. I'll go fast. Now, somebody may be wondering, hey, what if, I'm not very interested in this topic of investing and I don't want to learn about this boring stuff. Find an expert. Spend some time, put some energy, get some help in finding somebody you can trust. Then you can stop worrying about it. But don't postpone the act of investing because you're thinking, I will do it when I learn enough. May not be practical. Let's move on. Let's talk about timing the market. We always hear about this. People keep talking about market will be here, market will be there, trying to predict where the market will be and how you will benefit from that. Unfortunately, market returns, market performance is random in the short term. Nobody can predict what will happen next week and next month. In the long term, yes, broadly grows with the economy. In the short term, nobody knows. And if anybody claims they know, then please run away from them because nobody knows. Around 60% of the return the last 20 years came from just 3% of trading days, and it's impossible to predict those days in advance. So let's look at the long-term history and see what it looks like. Let's just play a little game. You may have seen something like this before. Let's play along. You had this 2-year period, April 2002 to April 2004. Almost flat, markets up a little bit. What do you think will happen? You may say, yeah, it just goes on this way. Who knows? Next 3 years are amazing. Market almost triples in value. Who would have thought? Now you say, hey, it started moving up. Maybe it keeps moving up for some more time, right? Easy. You park in your money. Boom. Global financial crisis, 08, 09, big crash, right? Of course, the dates are here, so all of you know what is happening. This is not a movie that you haven't seen. We all know how the movie ended or what's happening, but some of you are still trying to post in the chat box, so that's fun. What happens after this point? Some of you may be guessing. Right? Let's see. Flat. Right? After that big recovery, flat. Then what? Finally, market started moving up. Great. Again, we try and predict. We say it keeps going up again. Yes, good. Continue to go up, though it wasn't easy. What happened next? COVID. COVID happened. All of us in June 2020 said the market will go down even further. That's not what happened. Market recovered. It's had the biggest rally ever. And so anyway, the point is very hard to predict what will happen in the short term. But if you can see the long-term trajectory has been upwards and to the right, if you're patient and consistent, I think you can do pretty well. Let's move on. We'll talk about another example here in timing the market. This is something we really like talking about. Do you want to be regular or do you want to be lucky? Let's take the example of 3 friends, right? And just for simplicity's sake, we'll give them names. All three of them invest 1 lakh rupees annually in the stock market. One is called Mr. Fortunate, invests all his money when the market is always at the lowest price in the year. So he benefits when it moves up. The other is Mr. Regular, always invests his money on the first day of every year. The third is Mr. Unfortunate, unlucky, always invests his money when Nifty is at the highest point. So it usually goes down from there in the short term. So it doesn't look so good, right? So what happens? How do these people do over a 10-year period? Any guesses? Right? Yeah. Well, I wish it was so easy. We all are kind of rooting for the Mr. Regular, but let's look at the results. Yeah. Right. Over a 10-year period, Mr. Fortunate makes 12%, Mr. Regular makes 10%, Mr. Unfortunate makes 7.4. Hey, you may say, hey, 12 is good. Maybe it's worth it. The problem is this. When you start trying to time the market, you can't say whether you'll end up fortunate or unfortunate, right? But if you play regular, you know you're going to get a pretty decent return, right? So the question is, do you want to take a chance or do you want to be regular and still get a pretty good return? We always tell our clients to go with regular because you're pretty sure you will end up getting a decent return just because of the natural growth in them. Okay. Number 6, again, I like this a lot. When you place too much trust in the recommendations of your friends or influencers, what are the problems with that? See, your friend may not be an expert. Your friend may just be somebody who's more active than you, or somebody who speaks very well about investing very passionately. So you think, hey, this person knows it. Yeah, let's listen to this person. Or maybe she made some good profits recently. So you think, okay, she knows what she's doing. Let's just follow her. Right? It's not so simple. Maybe your friend is just relying on something he or she saw in the news, or maybe she got lucky, or maybe she's just not qualified. Who knows, right? Point is, just because he or she is your friend does not mean you should rely on them, right? Even if your friend is an expert, they may not have the same goals as you. So when they guide you, they may be telling you something not knowing what your goals are. Everybody has a different risk profile. Your friend may have a different risk profile from you, right? You may be, so your friend may be interested in doing something very risky. You see here, this person is probably invested in something like a Nifty 50 kind of product, very volatile, but good returns over the long term. You, on the other hand, don't have the risk appetite. And so you're better off in a more stable product until your friend understands that he or she may end up giving you the wrong advice. So you may end up making a mistake because of this. Please keep this in mind when you look at your friends' recommendations. Next, what's wrong with influencers? We are surrounded by them. There are tens and hundreds of influencers, Instagram, Twitter, wherever you look. What's wrong with them? First of all, often they have a conflict of interest. They may be paid to promote an app or an investment, and you may not be aware of it. They may not even tell you. So you listen to them thinking this is great, but they're being paid by this company and therefore they're promoting it. Second, they may not be qualified to talk about investments. Investments is a complex technical topic. It's not just something anybody can or should be talking about. Right? So they may not be qualified. They have no skin in the game. It doesn't matter whether your money goes up or down. They get their likes, they get the viewership, they talk about something and they move on. And so they have no accountability. They can make any recommendations. And, they may want to provide a popular point of view, get clicks and likes. It doesn't matter whether it's the most accurate, it actually does well for you or not. Right? What's popular, what's fun. Hey, so people will start talking about crypto. Why? Because crypto is popular, but hasn't done very well, right? It's been a disaster for many people. So please be careful when you listen to influencers. We'll go a bit faster. We don't have that much time left. Also want to save a little bit of time to tell you about Mighty. Very quickly, number 7, chasing the hottest thing. Like as humans, all of us have this tendency to chase the herd, follow what our friends are doing, etc. Right? Now, in the field of investing, sometimes that goes against you. Right? There are many examples. Crypto is an example. US tech stocks are an example. Recently, Adani stocks, if you thought for so many years have done well and it's going to continue, maybe not. Right? Now, in investments, there's a concept that something is priced in, which means whatever positive future developments you're expecting, the market has already taken the value of that into the stock. So you're not going to get any extra benefit tomorrow. right? So, but you don't know what's priced in when you're investing. Any information that's out there, that's in the public domain, probably is already priced in. So don't expect that just because you picked up the newspaper today, read something good about a company, that that company is going to do well tomorrow, right? The market already knows and it's priced into the stock. Keep that in mind. Let's look at an example, right? Tech stocks, we've all heard of this great 10-year-long bull run we've seen, 2011 to 2021. Some of us were lucky to participate in it, some of us were not. Investing in US stocks became widely available to Indian retail investors in late 2019. Okay, 6 months, maybe, or 4 months before COVID. And sometime in 21, a lot of Indian retail investors got very active investing in US tech stocks. Why? It had an amazing recovery after COVID, long-term track record looked unbeatable. What happened after that? November 21, the long bull run ended. Interest rates started to go up and tech stocks started to struggle. Not so easy. Very quickly talk about cryptocurrency. Everybody knows about this. Amazing parabolic rise. Retail participation explodes in 2021. And then bad news. This has happened again and again in the markets. So when you see something that looks like it's a sure thing, boss, this is going up, that is a time when you should be careful. Okay, please keep that in mind. Okay, next thing, another favorite topic of mine, buying the dip in individual stocks. When you start investing, you think the route to wealth is to buy individual stocks and the route to wealth is to buy things cheap. So you think Adani Enterprises has fallen 60%, maybe it is cheap, right? You buy it, doesn't do very well after that. So let's see, why does this happen? There's something called anchoring. Anchoring means you get anchored to the first piece of information you come across. So in the context of investing, when you come in and you see a stock trading at 100 rupees, you think it's worth 100 rupees. Somebody guessed what we're about to talk about next. So you think it's worth 100 rupees and you think that's the value of the stock, but actually it's not. You don't know what the value is, but you're anchored to 100 rupees. Mean reversion, you expect that an asset's price or returns will converge to historical averages. But as humans, we all have this tendency. We think, hey, it's gone up too fast, it will come down. It's gone down too fast, it will come up. Doesn't always work that way. Let's look at an example. Here's a company in a matter of 4 years, 4.5 years, went from 50 rupees to 400 rupees. Any clues what we're talking about? One of the most popular stocks. One of the largest banks in India. I think people are getting close. Few people have guessed. Yes, correct. It's Yes Bank. And I was unfortunately one of the people who made the same mistake that I'm warning you against here. After that sharp rise, it falls to 50% of its value within 3 months. People say, hey, look, this has happened before. This happened when it went from 275 to 200 and back to 350. So it's temporary. It will go back. And sure enough, yes, it does. The price recovers. Price recovers from 150 to 250, and people are like, okay, great. This is it. People pile in. People start buying, and then a really steep fall happens. It goes from 250 all the way to 50, and people keep buying the whole way. What happens next? All of us know. It never recovers. Some of us kept buying all the way from 200 to 50 rupees, thinking that this can't go down any further. And yes, I mean, you know what happened after that. Next, let's talk about unregulated financial products. Huge mistake according to us. What's a regulated financial product? It operates under a well-defined legal framework, which means there are rules about what this product can do, can't do, how it operates. Right? What are examples? Stocks that you buy yourself or through a small case, mutual funds, bonds. These are regulated by SEBI. Right? There are clear rules. Banks and corporate FDs, again, regulated by SEBI and or RBI. P2P lending regulated by RBI. Angel investing through AIFs regulated through SEBI. So you're safe when you invest here. There may be fluctuations value, but you won't get cheated. But there are other products out there, unregulated products. Okay, very limited rules operate here. You don't know what can happen. You can get cheated. Bad things can happen, and you won't have anybody to go to that. What are examples? Cryptocurrency is a primary example. A lot of us have fallen victim to this in some form or the other. Digital gold, it's become very popular, right? But SEBI doesn't allow you to sell digital gold, any registered entity. Of course, I'm not saying digital gold means your money is at risk. I'm just saying that the rules under which these investments operate is completely opaque. Somebody has a gold somewhere, you get a digital something, sure. There's a lot of hidden costs, GST, you're not aware of all this. There's no clarity on all this, right? Asset leasing to earn good rates of return. This has become very popular these days. Please keep in mind, a little bit risky, structure is a little bit gray. If something goes wrong, you're kind of at the mercy of the person who's set up this instrument. Angel investing through these new exotic structures where small amounts are being invested, very, very gray area, not safe, not recommended. Finally, somebody comes to you selling you stock tips. I'll tell you the hottest stocks. I'll tell you how it will go up. Right? Please be very careful. Let's move on. Last one, foregoing easy tax savings. Why is this such a big deal, right? We always hear money saved is money earned. But in the same light, taxes saved are also money earned. But people ignore, postpone, or forget to do things that can save them a lot of money in taxes. Let's talk about some of the most common mistakes when it comes to taxes. Taxes are worthy of a long discussion themselves, but we'll talk about 3-4 big things. One is forgetting or postponing Section 80C savings until the very end. When your company HR starts chasing you for investment proofs, that's when you first think, oh, I need to invest, I need to do something. Okay, which fund, where do I go, what do I do? Right? You don't have enough money, you don't have enough savings to avail of the full 80C benefit, so you lose out on tax savings because of this. Instead, you should be planning this from April, and you should be making sure you avail of the full 1,50,000, right? It's a big amount. Second, forgetting to use deductions like Section 80D for health insurance or Section 80 TTA for savings bank interest. All of us have some interest in savings bank. Ideally, we can get a deduction for it. Of course, we have to show the income as well, but it's tax exempt income up to 10,000 rupees that we should be using. Next, investing money in FD, because that's the only thing we understand, seems easy, right? While debt mutual funds will have the same returns with half the tax rate. So this is another common mistake people make. And finally, trading actively in international stocks and paying the full tax rate. If you're in the maximum tax slab, you'll pay 33% in taxes when you trade international stocks. If you do the same thing with Indian stocks, you'll pay 15%. Now, you may think international stocks are exciting, but once you factor in this tax point, yeah, maybe not necessarily you come out ahead, right? So great, we've actually managed to cover everything. Quick recap. These are the 10 things we covered today. Happy to take questions during the Q&A. I'll just take a few minutes to talk about Mighty and who we are, what we do. In fact, our company has been built around a lot of these principles, consistent investing, long-term investing, using scientific principles, etc. So let's learn a bit about what we do, who we are. We make expert investing guidance accessible to retail investors. Our core product is multi-asset portfolios of mutual funds. And these products or these portfolios help you achieve good returns while managing your risk. We have done rigorous quantitative research, looked at 27 plus years of, since 1995, financial market data to construct these portfolios. So, a lot of thought and research has gone into what we've built. I'll show you the results. We've had a really great run. Last 12 months have been amazing performance for our portfolios. What are the other things we offer? We offer tools to simplify financial planning and to save taxes. I'll show you one of those just now. We also deliver a lot of original content to learn about personal finance and investing. This is an example. Everything you talked about, you saw here today is original, developed by us. We've got a lot more content like this that we share with our users. And then access to money mentors, access to advisors who can help you understand things, who can answer questions for you, etc. Right? We're live on the Google Play Store. Please go search for Mighty on the Google Play Store, or just go type bit.ly/Mighty app in your Google or browser, anywhere, search engine, and you'll find it. Yes, we're not yet on Apple. That's maybe 2 months away. But yeah, please be patient, and at least you can use our tools and other things until then. right? We have a tax tool that we've developed. This actually addresses the problems a lot of us face. How do I optimize my taxes? There are huge opportunities, whether it is optimizing the structure using your deductions and exemptions, or doing other things which will help you save. Some of our clients are able to save 5, 7, 10,000 rupees just because they spend 3 minutes to use our tax tool. So it doesn't cost you anything. Just go register, use the tax tool. This is what the final output looks like. It will tell you exactly, customized to your inputs, what are the things that you need to do to save taxes, right? You can get an email summary if you want. Now, let me show you something that I am quite proud of, and our team is quite proud of, right? What is the 5-year performance of our portfolios versus the Nifty 50 versus the market, right? I'm showing 3 of our portfolios here. Our riskiest portfolio, Mighty Seeker, 18%. Our lowest risk portfolio, 12%. It's still beaten the market. Right now, you may say, "Hey, yeah, you beat the market, but are you taking more risk than the market?" Let's look at that. Right? We all know FY20, what happened. COVID struck. The markets had a huge fall. As we know, as you can see on the right side, Nifty 50, FY20 year fell by 29%. Right? If you were owning the market broadly, you lost almost 30% of your money. What happened to our portfolios? Our most risky portfolio fell by 8%. Our least risky portfolio didn't have a loss in 2020, right? So that gives you a sense of what we're talking about when we say managing risk while earning good returns. These are all built on scientific principles. Let's talk about recent performance. We all know the markets have been very volatile. Nifty has been flat or gone down in some cases. If you look at the last 3 months, Nifty is down 7%. Our portfolios are roughly flat. If you look at the last 12 months, Nifty is up 5%. Our portfolios are up anywhere from 7 to 10%. So in good times and in bad, I think we've proven that these portfolios actually deliver and perform. So please check us out. Go to the Mighty site, go to the Play Store, download the app. Please reach out for any questions. I'll leave you with one small thing here. We do something called Ask Mighty Anything. You can find it on the Mighty website, or you can just type in this link, bit.ly/mightyama, and you can go and post your question. Any question about taxes, personal finance, investments, a trained person, a financial advisor, will respond to you in writing within 3 business days. Okay, and nobody has ever not gotten a certificate. We have very good ratings on this. Please try this out. If any of you have complicated personal private questions coming out of this session, this seminar, please post them there and we'll get back to you with all our answers. Okay, great. Yeah, very funny. I think it's not Chat GPT, this actual trained people. Let's move on to Q&A. Aisha, please feel free to step in if it helps. There's also a poll. Request all of you to please post, how did you like the session? We will use this session to improve this for future users. So request you to please post your most honest opinion. And we really thank you for attending and giving us your feedback.
Thank you so much, Rajeev. We'll just step in for the questions. In case you have any questions, please let me know. I'll just come up and see if there was any question that we missed. Tax rebate on interest paid on housing loan. I'm not sure if that's a question.
Yeah, not really. I think we should move on. I think that was not a question. I think that was a response to the point we made on that particular slide.
Okay. Any questions regarding whatever we talked about, all these mistakes that you are following? And if you resonate with any of the mistakes that you have been doing, or like you have moved on from doing so, you can drop us and let us know. Very informative, got a different perspective. Thank you so much, Rajeev. It's for you. How flawed index funds are even when it comes to major falls in share with big companies such as Adani. Will this issues disappear in long term?
Great question. Great question. We've all seen what has happened recently with companies like Adani Enterprises, etc., being a big part of Nifty 50, even Nifty Next 50. Now the question is, while these are index a lot of people are blindly selling passive products and index investing. Keep in mind that the Indian indices are not hugely diversified. 50 companies is not sufficient diversification. So Nifty 50, for example, if somebody is telling you just buy Nifty 50 and forget about it, not a great idea. I would not take that advice. Similarly, if somebody tells you to buy Nifty next 50, same thing, right? For our clients, we do two things. We tell them that the mid cap index, for example, with 150 companies, has a much better diversification. There are very few products, unfortunately, but the products that are there are good. The passive products, or you can go with active funds, which are very well diversified and avoid this problem. In the long term, what needs to happen, to Jatin's question, is there need to be more of the indices. There needs to probably also be better methodologies of constructing the indices so that they are not impacted. Let's move on. Aisha, please feel free to step in. I'll pause here.
Dividends are taxable.
Yes.
How to know when to buy home?
I mean, I'll take a crack at it. I think this can be a 1 hour long session, to be honest. I think buying a home is, of course, a deeply personal choice. It's about when are you a little bit settled with your finances, little bit settled with where you are, and you also have a good idea what you need from a home. Home is not a pure investment. It's probably the only financial asset that can also be consumed or enjoyed. And therefore, you need to buy something that you will enjoy and like living in. We normally recommend to people that it's a good idea to maybe wait till you're mid 30s. Maybe you're married, maybe you start having children and you start thinking, okay, hey, you know what, I don't want to keep moving because my child's school is nearby or something. And maybe around then is where I would normally recommend people to buy a home. Right, but yeah, I mean, it really depends on your personal circumstances. Like I say, if you struggle to save and struggle to set aside money, the good thing about having a home EMI is it actually forces you to save a large portion of it. So yeah, you need to make that choice.
Should we invest on an individual stock or a Nifty 50 or an index fund? We won't be able to give you an exact advice, but you can suggest some measures.
Yeah, sure. We'll again keep it high level. I think we don't recommend anybody pick only individual stocks and invest. Even if it's 4 or 5, that's not sufficient diversification. You need to have at least, probably 15 stocks or 12 stocks or more to have sufficient diversification. Nifty 50 is a decent first option for somebody starting off, in spite of all the pitfalls we discussed earlier. What we recommend to our clients is to build a truly diversified portfolio of small cap, mid cap, debt, gold, international equity, various funds, 6 to 7 mutual funds. Good diversified portfolio will not keep moving up and down every day based on random fluctuations. That's what we recommend. But if somebody tells you just buy Nifty 50, not a bad starting point, to be honest. Yeah, it's better than keeping it in the bank.
Investing in real estate through SPV, like property share, is this a regulated product?
So there are 2 flavors of this. A regulated product, if you're a high net worth individual, you will do this through an AIF called an alternative investment fund. The minimum ticket size is 1 crore, which means it's out of the reach of most of us. Therefore, most of the time what happens is you do it through an SPV. This is unfortunately not regulated, in the sense that it is loosely regulated because it's a corporate entity and some Ministry of Company Affairs laws will apply. But no SEBI, no RBI, no financial regulators looking at these products. And these are therefore not something that we recommend putting a large part of your money in.
How can a young professional who earns about 50K start investing or planning for it?
So our recommendation is to start with mutual funds and to start with a diversified portfolio of mutual funds. Right? Like I said earlier, don't want to kind of talk too much about our products, but please feel free to ask us questions as well, and we'll help you construct a diversified portfolio of 6 to 7 funds where you can get started and keep building steady. So diversification is important when you think about starting out. And then once you've built a little bit of a base, oh, by the way, I forgot to mention, you need to have an emergency fund, right? So before you start investing, make sure you set aside 6 months at least of expenses so that you're safe in case there's some unexpected situations in your life. Once you have that in place, please start investing in a diversified portfolio. And once you feel you've built a decent base of a diversified, stable portfolio, you can do more exciting things like buying stocks and things like that. But always, diversified mutual funds are the best way to start.
If I buy and sell based on the market, where will I get more beneficial? Metals like gold or index fund or market material?
See, won't take too much time. It's a very specific question, and it depends on a lot of other things. If you are trading very actively, commodities are very volatile, require leverage as well sometimes, etc. So it really depends on a lot of things. Maybe we shouldn't answer this in this forum.
I'll just take a very few questions from the selectively. Is this the right time to invest now in mutual funds, or wait for a few years as there is more fear of wars and pandemic and recessions? I think that's what he meant.
So yeah, this question is always a difficult one, right? Like I said earlier, there's always bad news around the corner. If you read 3 newspapers, you'll find 30 things to scare you. And the thing you can therefore do is say, okay, boss, let me wait 6 months, 1 year. But there's never perfect clarity that, okay, now everything is smooth, let's invest. Doesn't work like that. So what we suggest is one of 2 things. If you're worried about what will happen in the market, look at a systematic way of doing it, invest a little bit each month and keep going. Right? That's a simple way of doing it. If the other way of doing it is if you have a lump sum and you're kind of worried what to do, you can buy a diversified portfolio. You can say, I will buy a little bit of equity, a little bit of debt, a little bit of gold. And for example, what we've seen with our portfolios is because we have gold exposure, that's really saved us in FY23. The Nifty is down, but gold is saved. So having this diversification thinking in portfolio terms can save you even if you're scared about what will happen in the short term.
What's your opinion on insurance plan linked with guaranteed returns, considering the new insurance amendment bill from next financial year?
Yeah, well, look, the problem with insurance plans typically is that they prey on the fundamental financial illiteracy that all of us have. When we are presented with large numbers, we don't understand exactly the maths behind it, right? So somebody says invest 10,000 for 10 years and get 1 lakh after 20 years. You'll think, oh, this is amazing. This is sounds very big. But the IRRs are not great. You may get 7% IRR, 8% IRR. Yes, you may get some tax benefits, but we don't really recommend these kind of products for one reason. Returns, yes, we may or may not agree. 8% post-tax, you may say, okay, decent. Or 7% post-tax, I'll live with it. But the problem is they're not flexible at all. You're locked in. You're locking in yourself to something for the next 25, 30 years. You don't know what life will be like. You don't know whether you will want to invest in this product. If you change your mind 5 years from now, you will lose money. You will not even get your principal back, which is why we don't recommend these kind of products. The new amendment is a whole different point, right? If you're investing large amounts in these products, hoping to save taxes and get a good post-tax return, that is now gone. So it's a double hit, but we don't recommend it because of the lack of flexibility of these products.
Okay. I think other questions have been answered by Papia and Syed over here in the chat. But as we come to the time, thank you so much, Rajeev. Thank you so much, everybody, for joining the session. I hope it was as useful as whatever mentioned. And if you are able to implement it in your future or right now, whichever that fits for you. Thank you so much, everyone, for joining. Thank you, Rajeev, again, for doing this amazing session with us. Everybody, there's Mighty app on the app Play Store. You can just download it. You can have a consultation. You can have an AMA and more for your benefit. Thank you so much. Bye. Have a great day. Have a great weekend.
Thank you, Aisha. Thank you, everyone, for attending. And if you liked our session, please post on social media, say something good about us. It'll help us. We're a young company. Thank you. Bye-bye.